What's the role and use of alternative investments in your portfolio? Well, here to talk with me about this is Tony Davidow, author of Goals-Based Investing. Tony, welcome.
Thanks for having me, Bob.
So a lot of folks wonder whether they should have, well, first of all, I wonder what alternative investments are, and then wonder whether they should have them in their portfolio. So let's start there. What are alternative investments?
Yeah, I think that's a great starting point because I think there's a lot of definitions out there. I would say broadly the way that I think about it, it's essentially hedge fund strategies and private market. And private markets include private equity, private credit, and real assets. Hedge fund strategies, as we'll get into in the discussion, are not all created equally. And I think that's where some of the confusion comes in, that everyone just assumes that all hedge funds are really designed to outperform the market, which is very difficult to do in a raging bull market.
Right. So you advocate that investors should include alts in their portfolios. Why is that?
Yeah, I think we just need to be realistic as we look at the market environment today. Most capital market assumptions that I look at, and Bob, we've had this discussion numerous times, are projecting substantially lower equity returns. We know we're in an environment with generationally low bond yields, something of the magnitude of $12 trillion in assets, of negative yielding assets around the globe. That's unheard of. And then, of course, we're starting to see signs of increasing inflation here and abroad. So given that backdrop, we'd argue that investors need a different playbook. And I think alternatives are multifaceted tools that can help fulfill a lot of the challenges we face in this environment.
Right. And you've mentioned, too, along the way that there's going to be a growing use of alts, and there's some factors that are driving that growth.
Yeah, I think that's fair. I think, again, alternatives have been used in a very, very big way by institutions. And, I typically start with a quote from David Swensen, who is the brilliant pioneer of portfolio management, the former CIO of Yale. And he famously made very big allocations to alternatives broadly, but very finite sort of slices. And he was largely successful because of that big alternative allocation. Hence, people tried to copy the endowment model. So I think they've been a big part of portfolios for large, sophisticated family offices and institutions for decades and decades and decades. So I think that's not new. I think what's new is today, a lot of these strategies are finding their way to high net worth investors or even retail investors. And I think that's a good thing. I think, again, the market environment is begging for a different playbook because the traditional sort of tools aren't going to get us where we need to be with our clients. And then lastly, I think we're starting to see, a series of new products coming to the market that make it easier for investors to get exposure and to understand what's going on. I'd argue there's still a great deal of education that needs to happen, but I think these strategies are becoming much more prevalent in high net worth investor portfolios.
Right. So speaking of strategies, do you want to give us sort of a laundry list of what kind of hedge funds are out there?
Yeah, I think the really important thing is to just start with the fact that not all hedge funds are created equally. And the one thing that I've heard certainly during the raging bull market of 2009 to 2019, everyone said, well, why would I invest in hedge funds if I can get these incredible returns coming from my equity allocation? Well, if the market continually went up in that fashion and you got double-digit returns, you may not need to consider alternatives. But the reality is that's not the market environment we're in. So what we need to identify what are the hedge funds individually or the right combination of hedge funds to help me solve for what I need in my client portfolios. Some are more equity beta oriented strategies like equity-hedged, which are equity surrogates where you're hedging your exposure, you're both long and short. Event-driven, which are taking advantage of some sort of structural change that's going on in the marketplace. Think merger arbitrage, think activist. Relative value, which is actually trying to take advantage of small mispricings available in the marketplace, kind of muting the returns and picking up nickels and dimes along the way. Macro, which you can think of as global macro and managed futures, which tend to have very low correlation or negative correlation to traditional investments, or a multi-strategy, which will own the right combination of each one of those. But each one of those underlying strategies are solving for different things, and each one can fulfill different sort of requirements of a portfolio.
So I guess a couple questions to follow up. One is, in terms of asset allocation, is there a recommended percent that one might commit to hedge funds?
Yeah, it's a great question. Certainly, the Harvards and the Yales of the world have 70% allocations, which I would not recommend. But I do think it's instructive to look at it, the best and the brightest and those who have very little constraints allocate as much as they're comfortable with. So to me, it's not just a mathematical determination. Part of it is you need to determine, what is the comfort level of having exposure to investments that I can't get out of in an instant. So think of what's your liquidity bucket. And then the other thing to think about is how am I thinking about allocating to these strategies, right? So if I'm allocating 100% of my hedge fund allocation to one strategy, I'm probably taking on risk. But if I'm allocating a portion of it to equity hedged, which is more of an equity beta surrogate, and a portion of it to relative value, and maybe a portion of it to macro, I'm actually getting a little offense and a little defense built into my portfolio with a little low to negative correlation built into it. So there's no exact science to it, but I'd typically argue that if you're going to do it, you need to do enough to matter. Mm-hmm. So I don't think there's anything wrong with thinking about 10 to 20% allocation to these strategies. For many high net worth families or ultra high net worth families, those percentages are well north of that. But at least as a starting point, I think it's important to allocate enough that you actually see a difference in your portfolio.
Right. And then in terms of looking or finding information about hedge funds, any thoughts about resources?
Yeah, I think, first and foremost, I would say the CIMA Association, they are the foremost experts on alternatives. They publish a lot. And Bob, as you know, we've actually had Keith Black of CIMA publish articles in the Investment and Wealth Monitor. So I think the Investment and Wealth Institute is a great source. I think CIMA is a great source. I think many of those managers who are offering those strategies, and many of them are traditional managers who happen to have alternative surrogates. So think of firms like PIMCO and Nuveen, a lot of the household names. Leverage them to get a lot of the research. And I would argue, and this is something, that we've talked about in other sort of podcasts and different sort of contexts, is never invest in anything you don't fully understand. So spend the time to understand it, ask the right sort of questions, make sure that you understand the role that it plays in the portfolio, make sure you understand that not all alternatives are created equally. And if you can identify the right ones, what is the expectation that you want from that investment over the long run? The worst thing to do is spend all the time, put it in the portfolio, and at the end of the day, you're disappointed because it didn't outperform the market. Well, I'm not sure that was the original goal of the strategy in the first place, but I think there was some miscommunication about what these strategies were designed to do. And a lot of people jumped into the pool without really understanding what they were supposed to get out of the investments in the first place.
Right. So anything that we haven't touched upon that is worth mentioning, or anything that you've already mentioned that bears reemphasizing?
Yeah, I'll just reemphasize where we started, which is I do think there is a role for these strategies. I think the market environment over the next 10 years or so will be challenging. And I think advisors need a different, more expanded toolbox. But what they need to do is they need to understand the role that these individual strategies play, and then collectively how they work in providing better portfolio outcomes, either in increasing return, dampening volatility, providing incremental yield, or helping to hedge the impact of inflation. And that's the broad moniker of what alternatives are designed to do for you. The other sort of teaser I'll give, because I know you and I have talked about this in the past, is our next podcast series will be talking about private markets, which I think kind of demand kind of a dedicated sort of focus, because those are very unique sort of tools, not as well known and understood as a lot of the hedge fund strategies.
Right. So before we wrap up, I just want to mention that the book Goals-Based Investing will be published shortly, and viewers can purchase the book where, Tony?
They can purchase it directly from Amazon or Barnes & Noble, or feel free to go to my site where I've got a direct link to the site as well. And that's tdavidowconsulting.com. And Bob, I appreciate the plug, and I appreciate the opportunity to speak with you today.